Hi everybody. This is lecture for topic 10, ACT3110. The title of this topic is capital budgeting or investment analysis. In this topic, you will learn about capital budgeting and decision making, definition of capital budgeting and capital budgeting methods. It is not very difficult. This is not a very difficult topic. Okay, capital investment analysis or capital budgeting is the process by which management plans, evaluates, and controls investment in fixed asset. So capital budgeting or capital investment analysis is like this. It is about the process how manager manage the purchase of fixed asset. Let's say in the future you are a manager. So capital budgeting means how you choose to purchase or not to purchase fixed asset for your organization or your business. So if you are a manager, when you want to purchase a fixed asset, for example, you want to purchase a piece of land or a building or a motor vehicle or an equipment or furniture and or etc. When you want to purchase that kind of fixed asset, the process is like this. First, you have to list all your alternatives. For example, at one time you have to purchase a lorry for your business. So you have to list all your alternatives. Lorry brand A, lorry brand B, lorry brand C, lorry brand D. There are many lorries. There are many brands. I don't know how to. There are many brands for lorries. Let's say brand A, brand B, brand C, brand D. Each lorry has different costs and different capacity and different power, etc. So if you are a manager, you want to purchase a lorry for your business, you have many choices. Okay, that is the first step. You have to list all the choices. The second step is you have to identify the cost of each lorry and also the benefit that you can get from the lorry. So the benefit can be in the form of cash in, or in the form of profit, or in the form of dollar of sales, etc. That is the step 2. Step 3 is you have to choose the best alternative. The best alternative in accounting, the best alternative is the alternative that has the highest benefit compared to cost. Okay, let's see. There are many methods that can be used to do the capital budgeting. Let's see. So this is factors related to capital budgeting. Okay, remember, capital budgeting is the process that a manager do to manage the purchase of fixed assets. So these are the things that are related to the process. So first, the first point is management plans, evaluates, and control investment in fixed asset. So the point 1 says that in a company or in a business, the party that is responsible for planning, evaluating, and control of the purchase of fixed asset is the management. Okay, so if you work in any companies, you have to know that the party that is responsible for the purchase of fixed asset is the management. Second point, capital investments involve a long-term commitment of funds. Okay, so the point number 2 says that if you are a manager, you have to know that the purchase of fixed asset involve a long-term commitment of funds. Why it involve in the a long-term investment, sorry, a long-term commitment of funds? Because most of the time a fixed asset is very expensive. So when you purchase a fixed asset, for example a piece of land or a big equipment or a motor vehicle, it is a long-term commitment. You have to pay for the purchase for many years, sometimes up to 10 years, maybe more. So you always have to aware that a purchase of fixed asset is a long-term commitment for your company or your business. Point number 3, investment must earn a reasonable rate of return. So the point number 3 says, if you are a manager and then you want to purchase a fixed asset, you have to aware that you have to purchase something that can provide return to your business. When you want to purchase something, make sure the return that you can get from the fixed asset, for example the land or building or motor vehicle or equipment, the benefit that you get from these things should be higher than the cost that you pay. Let's say you purchase a machine, the cost of the machine is $200,000. You have to make sure that the machine can benefit you, can provide return, or can produce something that will give your business return more than $200,000. If you pay a machine $200,000, but the return that you get from the machine is only $150,000, then that is not a good decision. Okay, always remember, in accounting, you do something when the benefit of doing it is greater than the cost. Okay, point number 4, the program should include a plan for encouraging and rewarding employees for submitting proposals. So this point number 4 says that if you work in a big company, there are many workers. So most of the time, the manager will receive proposals from the lower level workers about the proposal related to the purchase of fixed asset. This example is relevant for a factory. If you are a manager in a factory, there are many workers. Most of the time, the workers, the technician or the supervisor will request or propose for a purchase of a fixed asset like machine, I don't know, equipment in the factory. That is for a big business. So when you are a manager in a big business, you have to make sure that you design a system that encourage employees and reward employees for submitting good proposals. Okay, so that is one thing. Another thing is, if you work in a small business or you own a small business, most of the time the purchase of fixed asset is coming from you, the owner of the business or the manager of the business, the manager of a small business. So you have to aware that. Okay, so this now, okay, I have told you earlier, capital budgeting means the process that a manager do when the manager want to purchase a fixed asset like equipment or plant or building or motor vehicle or etc. So to make a good decision, to make a good purchase decision, the manager can use these 4 methods. These 4 methods can help the manager to purchase the good fixed asset. Like I said earlier, if you are a manager, when you want to purchase a fixed asset like lorry, you have many choices. You have alternative A, B, C, D, brand A, brand B, brand C, brand D. They are almost same. They can do the same thing, deliver a product from one place to another. But each of the alternative has different cost and benefit. So if you do this method, you use this method, you can choose the best alternative for your business. Okay, the first method that can be used to do the capital budgeting is called the average rate of return method. The second method is called the cash payback method. Okay, these two methods are methods that ignore present value. Present value is a concept related to the time value of money. Time value of money is something like this. If you have some cash now, the value of the cash will increase over years. Let's say you have now $10,000. If you keep the cash in the bank, next year it will become maybe $10,200. If you keep the cash another year, it will become 10,450 maybe. If you keep another year, it will become 10,800 maybe. Okay, so the concept of present value means the money, the amount of cash or money will change over time. The amount that you have now will become bigger in the future. A big amount in the future is less if you calculate the amount now. Okay, again, if you have the value of the amount of cash you have today will become bigger in the future. A big amount of cash in the future is a small amount of cash now. Okay, so that is the time value of money or present value. So these two methods are the methods that ignore present value. Okay, another two methods, the next two methods are the net present value method and the internal rate of return method. These two methods are methods that use present value. When you use present value, you have to refer to the present value table, or you can use the scientific calculator to calculate the present value of money, the future value of money, etc. So let's see the first method, average rate of return method. Okay, remember this. This average rate of return method, the method has several advantages and disadvantages. The advantages are easy to calculate, and then the second advantage is considers accounting income or profit. Income or profit often used to evaluate managers' performance. Okay, these are the two advantages. The disadvantages is it ignores cash flow, and second thing is ignores time value of money. Remember this, the average rate of return is a method that focus on profit, so it ignores the cash flow. Cash flow is important in a business, but this method focus on profit only. It ignores the cash flow. Okay, let's see. This is an example. So purchase of machine example. Assumption, machine cost. Okay, let's say this is something like this. There is a manager in a business, and then the manager has to receive a proposal. The proposal request for the purchase of a machine. So let's see, the machine cost is $500,000. Expected useful life is 4 years. Useful life means how many years the machine can be used by the company. Residual value is none. Residual value is the value of the machine at the end of the useful life. Let's say a business want to purchase a machine like this machine, the machine is expected to can be used for 4 years. At the end of the 4 years, if the machine can be sold as a second-hand item or can be sold as a recycled material or anything, then it has a residual value. But if the machine cannot be used anymore and cannot be sold anymore, the company has to dispose the machine, then it is a fixed asset that has no residual value. Okay, expected total income is $200,000. So expected total income means expected profit. The company estimate that the proposal estimates that $200,000 profit can be earned by using the machine. Okay, how to calculate the average rate of return? So to calculate the average rate of return, you have to use this formula: estimated average annual income divided by average investment. Okay, so let's see how to calculate that. So you have to remember this. The average rate of return, so the formula, you can see here the formula. The example of calculation is the thing that you can see below the formula. So let's see how to calculate the estimated average annual income. The estimated average annual income is the expected total income, 200,000, divided by the useful life. So divided by 4 years, divided by 4. And then you have to calculate the second thing, something below the formula. So the average investment. How to calculate the average investment? To calculate the average investment, the way is the cost of the item plus residual value and divided by 2. So always remember, the average investment, you always have to divide the number by 2. Okay, so $500,000 in this sample situation, the residual value is 0, so plus 0 divided by 2. For this example, the average rate of return is 20%. So remember this. For this method, the higher the percentage, the better the investment. Let's say you are a manager, you receive proposal to purchase machine A and machine B. The higher the percentage of the average rate of return, the better the proposal. So let's see in this example. See here, the example here is like this. There are two proposals. Proposal A, the average rate of return is 25%. Proposal B, the average rate of return is 20%. So if you are a manager, you should use you should choose the proposal A, because the average rate of return is higher compared to the proposal B. Or in other words, it shows that proposal A is more profitable compared to proposal B. Okay, this is another sample question. Let's see. Determine the average rate of return for a project that is estimated to yield total income of $2,736,000 over 3 years, cost $690,000 and has a 70,000 residual value. Okay, determine the average rate of return. So how to determine the average rate of return? You have to use the formula. Okay, remember the formula. First, you have to calculate the average annual income or average annual profit. How to calculate the average annual profit? Total profit or total income divided by the useful life. So in this question, the net profit or total income is 273,600 divided by the useful years is 3 years. So the average estimated average annual income is 91,200. So divided by the average investment. How to calculate the average investment? The average investment is the cost of the fixed asset plus residual value divided by 2. Okay, so for this scenario, the average investment is $380,000. So how much is the rate of return, the average rate of return? The average rate of return is 24%. Okay, just remember, you have to use the formula. Okay, this is the second method. The second method that you can use to choose the best fixed asset for your business is the cash payback method. Okay, so the expected period of time that will pass between the date of an investment and the complete recovery of cash of the amount invested is the cash payback period. Okay, it means that for this method shows how many years your company can get back the cash that you have invested when you purchase a fixed asset. For example, let's say at one time you are a manager and then you are thinking about to purchase an equipment for your business. So you have 3 choices: equipment 1, equipment 2, and equipment 3. If you use the cash payback method to evaluate these 3 choices, then this method will show you for machine A how many years your company will get back your investment. For machine B, this method will show how many years your company will get back investment if you purchase asset B, equipment B. For equipment C, same thing. The method can show you how many years your company can get back the cash that you have invested for the machine. So let's see how the example. The excess of cash flowing in from revenue over the cash flowing out for expenses is termed as net cash flow. Okay, net cash flow means cash in minus cash out. If you have a business, every day you have to pay for something, and also mostly every day your business will get cash. Your business will get cash when customers purchase something, or when you provide services to your customer, they will pay you cash. Also, you can get cash from investing in something. Okay, so net cash flow mean if you see the term net cash flow, it means that cash in minus cash out. Okay, let's see here. This is a sample scenario. At one time you are a manager, and then this is a process of purchasing a fixed asset. The investment cost or the purchase cost of the fixed asset is 200,000. Expected annual net cash flow equal to 40,000. Net cash flow, remember, net cash flow means cash in minus cash out. So every year, if you purchase this fixed asset, the fixed asset can generate net cash flow of 40,000. So how to calculate the cash payback period if the situation is like this? So to calculate the cash payback period, you have to use this formula. Total investment divided by annual net cash flow. Very easy. So for this fixed asset, the cash payback period is 5 years. It means that if the company purchase this fixed asset, the company will get back the amount they invested in 5 years. If in this scenario, the company has to invest for the fixed asset is 200,000. To get back the 200,000 that they have invested, they have to wait for 5 years. So for the cash payback method, let's say you have you are a manager, and then you have you want to purchase a building, and then for your business, and then you have 3 choices: building A, building B, and building C. Okay, and then you use the cash payback period method. So this method will show you, let's say building A 20 years, building B cash payback period is 25 years, building C cash payback period is 30 years. So which one is the best choice? The best choice is A, because A is 20 years. It is the fastest. The building is has the lowest payback period. It means that if the company purchase building A, the company can get back their money quickly, 20 years, compared to buildings B 25 years and building C 30 years. So the quickest payback period, the faster the payback period, the better the investment. If the the net cash flow is not equal every year, then you cannot use the formula in the previous slide. You have to use this table. Okay, let's see here. If the proposed investment is 400,000, the payback period is at the end of year 4. Okay, why at the end of the year 4? Sorry. So in this, if the return or the cash flow from the asset is not equal every year, then you have to use this table. For example, here the investment is 400,000. The net cash flow is 60,000 in the year 1, 80,000 in the year 2, year 3 105,000, year 4 155,000, year 6 100,000, year 9 90,000. So after you have list all the unequal net cash flow, you have to calculate the cumulative net cash flow. Cumulative net cash flow means cash flow year 1 plus cash flow year 2 plus cash flow year 3 plus cash flow year 4, and then plus year 5 plus year 6. That is the cumulative. After you have calculated the cumulative net cash flow, you have to identify where is the point the company will get back their investment. So in this sample question, the company will get back their investment of 400,000 at the year 4. Okay, this is the way. Okay, you can also show the number in a graph like this. You can see that in year 4, the company get back the amount that they have invested, 400,000. Okay, these are the advantages and disadvantages of the payback method. See here? Okay, the first advantage is considers cash flow. Cash flow is very important in a business, isn't it? If a business has many cash, then the business can survive can pay back their liabilities, etc. So this method is good because it considers cash flow. The second advantage is shows when funds are available for reinvestment. It shows, let's say the payback period of one item is year 5. So it shows after year 5, the company has cash. The company can use that cash to purchase other things or to do other things. Okay, that's a good thing. There are two disadvantages. The method ignores the cash flow occurring after the payback period. So when you do the calculation, you calculate up to the payback period only. But the machine will still exist after the payback period, but it does not included in the calculation of this method. So that is not a good thing. Number 3, the disadvantage is number 2, does not use present value concept. So this is a weakness. You see, when you use the cash payback method, you have to see the net cash flow in the next several years. But when you calculate the cash payback method, you does not use the present value. Okay, so there's not that is a weakness, because the amount of cash is affected by the interest rate. So if you do not use the present value concept, then it is a disadvantage. Okay, let's see, another thing that you have to know, which method is better? Average rate of return method better, or the cash payback period is better? So the answer is, we cannot say which one is better, because each method has its strength and weakness. For example, when if you use the average rate of return method, the strength is the method is based on income or profit. The higher the profit, the higher the rate of return. When you use the cash payback method, the basis is the cash. Both profit and cash are important. So you cannot say which method is better than the other. If you are a manager, the best thing to do is you use both method. Or if it is possible, you use more than 2 methods to evaluate the purchase of a fixed asset. The more methods that you use, the better decision you can make. Okay, so these are the 2 methods that you have seen, methods that ignore the present value. Okay, so there are 2 more methods. So this is an example. A project has estimated annual net cash flow of 30,000. It is estimated to cost 105,000. Determine the cash payback period. So this is easy, isn't it? You can use the formula. Okay, so the formula is 105,000 divided by 30,000. So the cash payback period is 3.5 years. Okay, these are the methods, the 2 methods that you can use to do what? To do capital investment analysis. And these 2 methods are methods that use the present value concept. So let's see the concept. I think I have explained a bit about this concept. It is related to the future value of cash and the present value of cash. So I will do this quickly. Okay, so now let's say you have $1 now. In the future, it will become a bigger amount, because every year you will get interest if you keep the cash, or you invest the cash. Okay, you keep the cash in the bank or you invest, the amount will become bigger. So it shows here $1 now will become $1.40 in the next 4 years if the interest rate is 12%. In another way, $1.40 in the 4 years in the future is $1 now. The value of $1.40 in the next 4 years in the future is $1 now if the interest rate is 12%. So that is the concept of present value. So if you want to use this present value calculation, you have to refer to the present value table. You can see this table in many finance textbook and also in the statistic textbook. Another way to do it quickly is to use the scientific calculator. You can calculate it very quickly using the scientific calculator. Okay, so I want to show this one, the methods. Which one is the method? There are two methods: net present value method. Okay, this is the method number 3. This method uses the present value concept. So let's see how to do it. So this is the example. At the beginning of 2008, the equipment with an expected life of 5 years can be purchased for 200,000. At the end of 5 years, it is anticipated that the equipment will have no residual value. So how to evaluate this investment? So if you use the net present value method, so this is the additional info. Net cash flow of 70,000 is expected at the end of 2008. And then this is expected to decline 10,000 every year except 2012 until the machine is retired. The firm expects a minimum rate of return of 10% should the equipment be purchased. So this is the situation. If you draw the timeline, the investment is 200,000. See, in the year 2008, January 1st, and then the cash from the investment is 70,000, 60,000, 50,000, 40,000, and 40,000. So if you have to use the net present value method, this is the thing that you have to do. You have to calculate the present value of cash for every year. Okay, and then you the 200,000 is the cash out, and there are 1, 2, 3, 4, 5 cash ins. So the cash out minus the cash ins, in this situation the net cash in or the net present value is 2,900. So in general, if the net present value is positive, it is a good investment. But if you compare several investment, the higher the net present value, the better the investment. Okay, if the item if the fixed asset is only one, the positive net present value shows it is a good purchase. But let's say you want to purchase one fixed asset, but you have many choices. Choice A, choice B, choice 3, option A, option B, option C. So the option that with the highest net present value is the best option. Okay, this is about the present value index. The present value index is the total present value of net cash flow divided by the amount to be invested. Okay, so this is the thing that I have said to you. The higher the net present value, the better the investment most of the time. Or the present value index. Okay, but that's the way to do it. So I just want to show you the way. Okay, there are advantages and disadvantages. Okay, now This is the method number 4. Method number 4 is internal rate of return method. Just remember, this method also uses the present value concept. Okay, and this method, using this method, you have to calculate what is the rate of return from the investment. Okay, so let's see the way to calculate that. In this example, you have to guess for a series of cash in. So you have to guess it is how many percent of return related to the investment. So in this example, the return is 15% return to the investment. The higher the return, the better the proposal. So it is quite complex, this method. This method has several advantages and disadvantages. As far as I can remember, this method is the best method. The internal rate of return method is the best method. It considers the return and also it considers or uses the present value method. Okay, remember this. You have seen 4 methods that can be used to evaluate the purchase of fixed asset. The first 2 methods are methods that ignore the present value. The methods are average rate of return method and cash payback period method. Okay, these 2 methods ignore the concept of present value. Now, you have to know how to use these 2 methods. Okay, if I ask you to calculate the cash payback period for the purchase of one fixed asset, you have to know how to calculate it. And also, if I ask you to calculate what is the average rate of return for this purchase of fixed asset, then you have to know how to calculate it. That is a must. Okay, and then you have to know what is the advantages and disadvantages of cash of the average rate of return method and cash payback methods. And the next thing is, you have to know that the methods that use present value concept are better than the methods that do not use the present value concept. Okay, and then in this topic you learn 2 methods that use the present value concept. The first one is the net present value method, and the second thing is the internal rate of return method. So I want you to know these 2 methods in explanation only. You have to know how to explain about these 2 methods. The net present value method and the internal rate of return method, they consider the time value of money. Okay, and they are in general better than the methods that do not use or consider the time value of money. Okay, thank you very much. You can communicate with me in the comment section.